I tell you what, everybody, it looks so similar. It's crazy. I've been tracking this for a while here, but this is the NASDAQ 100 in 2008. This is the NASDAQ 100 right now. This is the NASDAQ 100 side by side with those dates. And this right here is the intro screen to the Stock Market Brief Show. If you're new here, welcome to the channel. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Got some interesting charts to show you today. Going to follow up on the last video, which was the weekly recap as well. Today's episode is brought to you in partnership with FTX. You can use code TRADERMIKE and get a free coin when you trade $10 worth. People ask me what I use to trade crypto. FTX. I'm sponsored by them. I use them. It's a win-win. Let's go ahead and get into today's episode. Well, hey, everybody. Welcome back to the show. As you know, tech stocks took off like a rocket ship. I tell you what, it kind of looked like a yin-yang. Yin-yang, right? So green here, red there. Yin-yang. Pretty crazy. But if we look at the side-by-side interaction of what's taking place in the markets currently, this I find interesting. So first and foremost, if we look at 2008, and you know, a lot of people don't like looking at analogs. I personally do because it gives you a good idea of maybe how people acted in that time frame. What were the emotions like? And you can read emotions on a price chart. And they're probably very similar to what they are now to what they were then. And you know, we use this chart originally for seasonality because typically you have these bump ups in seasonality in March to April, some of the strongest months based on seasonality. And you can see that here, right? We talked about this. When did we talk about this? I think we talked about it actually. So we brought it up, this chart, on this day here, and we said it drops one day and then typically rips up higher. So we pretty much caught the bottom. Now, I'm pointing this out because I see something else really interesting. So first and foremost, from the bottom to where we are now, to where we hit a high of before the little pullback, around 17.4%. In 2008, we rocketed up around 23%. So understand that like after this big drop off from up here to down here, it caused a lot of fear and panic. Very similar to right here to down here, it caused a lot of fear and a lot of panic. Then we ran 23%. Imagine the feelings and emotions and what was going on in the news at that time. Oh, stock market's recovering, all is well, things are going to be good. Now keep in mind, this right here, that little marker right there in the middle of May, that was the final top before the 2008 financial crisis. It started going down, it came back up, never broke that high, and then we started heading significantly lower. Okay? Now, why am I bringing this side-by-side comparison up again? Well, now we're moving into the month of April. April's typically a strong month based off of seasonality. But then when you look at midterms and you factor in a bunch of stuff, it's a little wobbly. Okay, now first and foremost, if we're just playing out this analog, technically speaking, we still have some more upside potentially to go. What do I mean? Well, first and foremost, notice here in 2008 how we kind of formed the wedge. We came up, we back tested it, and then we came down and we moved up a little higher. Well, very similarly, we formed a falling wedge, we hit it. We pulled back, and now we're rocketing up a little bit, okay? So it actually broke out through this and came back up to this previous little gap right up here. So if this were to break up, did you know that 23% would take us right back to this little previous peak high right here, which is basically, yeah, that's 16,000, 16,200, that zone right there. Tell me that people wouldn't be excited about hearing something like that. And there's no reason why it can't just continue to go higher. I'm not saying that it's going to be the 2008 financial crisis here, but check this out too on top of this. Take a month to look at April here in 2008. What do you notice about the very first trading day? I mean, almost the very first trading day. So today is the 4th. We traded one day in April so far, I think Friday, if I'm correctly. So look at this big bullish day right here in April. It was basically open, and then it closed at the high. Look at this one right here. It basically gapped up, opened on a gap up, and then closed at the high. Pretty crazy just side-by-side comparison. Now what happened after that, it actually drifted up a little bit higher, and then it started doing a mid-month pullback, and then started rocking higher. So is this, a minor pullback? Are we going to see a deeper pullback into April, and then are we going to move a little bit higher? And is May going to mark maybe potentially more of a top? Well, if it follows this exact motion, then yes, and it has been following it pretty exact. But I just wanted to share that with you because it is very interesting just how not only how the price action looks so similar, but even the dates, right? If you haven't seen the previous video where I talked about this, but 2008, right? Bam, it fell like 20%. Then 2022, bam, right out of the gates, it fell about 22%, something like that, right? And then at the same time, pretty much to a T, we started breaking out of that wedge and we started heading higher. So, if everything stays the course, why couldn't we push potentially higher? Now, I'm going to talk more about the risk ranges of where we ended later in this show, but I also want to pull up this. This does show a little bit of difference here. This is the 10-2 spread, and the reason why I'm showing it is just a good visual as to just how much of a corner the Fed is in right now. First and foremost, when the yields invert, that's an early indication that, there could be trouble up ahead. It's been a very good indicator of future recession to come, whether that be 6 months, 1 year, 2 years, whatever the case may be. Now, during the recessionary times, when we have a recession, you can see what the Fed fund rate does. Now, the Fed, right, this gray shaded area in the back is the Fed fund rate. And typically when we have a recession, they move rates down to darn near zero, right? Just huge smashes. So every time that the curve inverted, boom, 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 and even boom, the Fed moved rates down significantly. Bam, to the floor here, and then we started moving them up. As soon as it inverted, flattened. What makes this such a good visual is we are inverted, but the Fed fund rate is darn near zero. So we're moving in to a tightening cycle right now. While the yield curve is inverting, it's flattening out, right? And on top of that, we have now Q2, which should show a slowing rate of growth. So you put this all together, it's just like a recipe of something to break here. I'm not saying that it's going to break right away, because we've seen markets throughout stressful periods actually rip higher and then things fall apart. But you need to be aware that there's clearly things in the market on these longer term timeframes that are quite askew. Messed up. There we go. This is the 11 sectors that make up the S&P 500. How did we perform today? Well, we have 3 that were massively in the green. That's communication services. You got XLY and XLK. Now, a big bump in all of this was really driven by the news from Elon Musk stating that he bought a 9.2% stake in Twitter. And that really started driving up prices, especially in Tesla. Now, if we take a look at Tesla, I look at their weekly risk ranges or expected moves here, and you can see that almost in one day, we're almost at that upper edge, which lets me know this move is not abnormal, all right? But in one trading day, we're already just about at that upper edge. So we'll see if the market gets some more FOMO and chase it up a little bit higher. But 68% of the time, right? 68% of the time, it closes within this channel. So the risk really here is, there's less reward to the upside, if that's the case, where there is more risk to the downside. But that's not the only one. If we take a look at Google, which is one of the top holdings in XLC, which was the top performing sector today, this is interesting. Google did tap the upper risk range today. It was off by a few pennies, but this is over a $2,000 product. And to come within cents of it, or $1 or so, is very, very amazing. And then it started backing off. So that was actually touched already, which lets me think that XLC, and then also, by the way, Facebook is another top holding. And that also, I think its total net assets in XLC is 16.5%. And then I believe Google is something like, well, there's 2 different classes. There's GOOGL and GOOG. I think GOOGL is like 13% and the other one's like 12%. Okay, so the fact that these already hit their upper risk ranges, it pushed XLC communication sector outside of its weekly risk range or expected move. So there's a possibility that we can get a further squeeze here, but it still lets me know that, we're already a deviation out from the risk range. So there's a big possibility that we pull back within it after this excitement kind of dies down here. If we take a look at Apple, Apple is also another big one that ran, and that one is also right there near the upper risk range. Why am I telling you this right now? It's because this is day 1 of this week, of the week. It's the first day, and we're already hitting about the upper edges of these risk ranges in these bigger time products, right? So if you look here at the heat map, like I was saying, it's a yin-yang, right? A lot of stocks were down, but yet you have these big dogs all playing with each other, which really helped drive the market. Now, if we take a look at the Qs, what happened? Well, on the previous video, we discussed, hey, if it takes out the high of this hammer candle, it would potentially go shoot up for that upper risk range, right? And that's exactly what we're seeing. Day 1, surprisingly, right? We're not too far from it. Last time we were there, we backed off. Is that going to be the same case here? We will see. Got back above that 200-day, and it closed at the high of day. Now, which is so crazy to me is if you look at these candles right here, almost every green day here has closed at the high of day. Every green one. You know what I mean? Like, take a look right here. It's pretty much at the high of day, even closer to the high of day. This was high of day. It's very close, pretty much high of day, high of day, high of day, high of day. Every single green candle from right here, from the 14th on, was basically at a high of day. What does that mean? Well, it means on the green days, it's very, very bullish, and it's just something seems a little bit off here, to be quite honest, that they're closing quite like this. Now, also tells me that there's a lot of strength at this particular point in time, but like I said, we're still here in this area of resistance, right? We're really, and if you zoom out even further, you know, we have a low here, we have a high right here. So right now, we're just in pretty much the middle of that range as it stands. So determining, I guess to better word this, it's not really about predicting where the price can go, but really just understanding where your risk to reward trade may be. So somebody asks me, you know, are you going short here? And I tell them, well, I've been long since down here, right? I've been scaling profits up in here. So I'm still holding long positions, including the S&P 500, including a couple of just random other stocks that are within tech, within other different sectors. But I've been scaling them back dramatically because of this big run. Now, what I'm waiting for is a period of consolidation. And we're just not really getting it, really. I mean, this was a subtle pullback and a strong move right back up. And now we're right there at the upper risk range on day one. So I'd like to see more consolidation and buy at the right price rather than just force myself into any specific trade at this given time. If we take a look at the SPY, didn't perform nearly as well, but that's also because financials wasn't kind of playing in this game, but we cracked through the high of the hammer candle. We started pressing higher. We're a little bit off the risk range still, so if we come up there, be aware of that number, which is just about 460. Now, I already stated the yield curves were continuing to compress, continuing to flatten out. I did notice that there was a pretty big spike here in the 3-month, so we'll continue to monitor that to see if the short-term the shorter end of the curve starts flattening out more because those have been steepening. If we take a look at the 10-2, the 35, right, they're still inverted at this particular point in time. The longer they hold down there, you know, the more powerful that signal can become. And also when we get the lower end, the shorter end of the curve inverting too, you know, that would be a more powerful signal as well. Now, if we take a look at the dollar is still consolidating sideways. Looks like it's about to break out at any time. So we'll see here if it's going to continue to chop back and forth, if we're going to get a breakout. I will note Bollinger Bands continue to tighten up. Remember, contraction leads to expansion, so that's going to be one to watch. If it explodes to the upside, it could very well put pressure on the S&P 500 as well as various commodities. Maybe oil, maybe gold, right? We don't know, but if you take a look at gold continues to be extremely volatile. It was up 4% today as the 50-period moving average is continuing to hold. But if you just take note, you zoom out, you got this massive expansion. Now it's tightly contracting within this little range, and we're pinched between the 20-period, which is declining, and an inclining 50-day moving average. So which way is this going to break? I don't know, but you know, it could probably be quite explosive of a move, whether it breaks to the upside or breaks to the downside. If you watch previous video, I showed this on the weekly time frame, and I made it look like Jesse Livermore's chart just to show you whether or not this was the blow off top right here at 130. Or technically another way to look at it is that was, if you didn't watch that video, you'd have to watch it to understand what the 8 means, but it could be potentially 8 where the 9 and 10 are significantly higher, and that's always a possibility there too. But we'll continue to monitor that as time progresses. Meanwhile, you know, even though oil was up 4%, energy stocks were, you know, down for the majority of the day, but they ended up finishing slightly up and not on the greatest volume. But what I will note about the volume and the pattern here is you can see on the move up here, it was a nice run up on stronger volume. And now you can see the volume getting very, very tight here, starting to just dry up. Meanwhile, the price action is starting to tighten up here too. So, you know, this is going to have an explosive move. I couldn't tell you if it's going to be the upside or the downside. I couldn't tell you if it's going to be an explosive move and a trap. I couldn't tell you if it's going to be an explosive move like that and a trap. But what I can tell you is we're probably going to see some sort of explosive move here soon. As you can see, these last 4 trading days, the closes on those candles, they're very, very tight. The volume's drying up. And remember what we said, right? You know, one of the basic principles in technical analysis is markets, they expand and they contract. They move through expansion and contraction. So there will be an expansion here in the very near future, I would imagine, with energy stocks. Let's go ahead and hop into crypto. Before we do, we're going to hear a quick word from today's sponsor, FTX. It is one of the largest cryptocurrency exchanges in the world in terms of trading volume and daily users. The FTX app is the most complete crypto app that allows users to buy crypto and NFTs with no fees, use a crypto debit card, and track their entire crypto portfolio. It's trusted by over 6 million people to buy, sell, and track their favorite cryptocurrencies. It is an easy platform to use. You can buy things such as Bitcoin, Ethereum, Solana, Dogecoin with zero fees in a matter of minutes. The founder and CEO of FTX is Sam Bankman-Fried, who is a highly respectable figure in the cryptocurrency space. To download that app, you can use the link in the description below and use code TraderMike to get a free coin when you trade $10 worth. All right, everybody, welcome back. Just a quick update on the Sailor to Shift tool. If you don't know what this is, let me know in the comments or look in the description. I'll try to put the Sailor to Shift video. This is like by far the best indicator I've ever seen. And I'm not biased to that because I made it, but it is like one of the best indicators that I've seen to indicate when to get out of the market and when to get in the market on a longer term basis, right? We're looking at the rate of change, the 4-week rate of change between Bitcoin and gold. So a very volatile asset and not volatile asset. It's called the Sailor to Shift tool because Michael Saylor is very pro Bitcoin. And then you got Peter Schiff, right, is very pro gold, but not Bitcoin. So it's like the opposite. So I called it that. Whatever. Besides the point, where are we right now? Well, the last buy signal was right here. The price got above it the prior week, and we're in the green right now. That was really the first real buy signal of this year. We had this one right here, but it whipsawed us out for pretty much a 0% gain, 0% loss right here. Is flat. This right here was a false signal, and now we finally got some momentum. I'm just watching to see if it starts heading back down. I am considering taking a little bit of profits off, but I'm just sticking to my current strategy. I'm tempted to, but it is what it is, right? So if this starts crossing down, gets below that zero line right here, that is when we'll really start to pay close attention to the price action. If you take a look at the daily time frame for Bitcoin, it's just consolidating right here as these moving averages are catching up. It was interesting thing on today. It was down the majority of the day up until later it started catching more of a bid, and I found that very weird because the Qs and tech stocks were ripping. Meanwhile, which has typically a tight correlation, is Bitcoin, and it was heading down. But you can see here that it clearly caught itself a little bit of a bid. Very similar situation with Ethereum. Ethereum continues to kind of just crank a little bit higher. So we'll see if that continues to hold. There hasn't been, which I don't like, some sideways consolidation. So perhaps we do still get that pullback as prices kind of just drifting, and then we can something like that where we can see an explosive move or see price like really tighten up here. But as it stands right now, it's just kind of floating higher and higher without much of a proper pullback. So it's either that or we see just an explosive move with a lot of volume to the upside, which would be fine too as well. But that's all I got for you on today's episode, everybody. Hope it helped out. Just to quickly recap, clearly something is off in these markets. So pay very close attention to your risk and how you're managing your money. It does seem like the market can continue to press higher given that we're closing at the highs of days. And if this wants to follow suit to 2008, I mean, if we're following exactly, it goes from 17, this one's 23, it says that, hey, we can press a little bit higher, but pay close to 16,000, and then also pay close to the middle of May, because the middle of May seems like right here is when you should have went away. All right, everybody, have a wonderful